I'd like to get everyone's thoughts now on your preferred way to be exposed to gold right now. So is it physical? Is it the miners? Is it via ETFs? Ian, let's start with you.
Okay, well, we've had our first a little bit of disagreement, I'm afraid, because our fund is 70% in silver at the moment. And we think the upside for silver so way exceeds the upside for gold. It's just not true. If you look at the previous highs, silver peaked at $50 an ounce, is now currently around $16, $17 an ounce. Gold peaked at just under $2,000 an ounce, and it's trading below $1,400 an ounce. For gold to retest its old high, it's got to rise 40%. For silver, and they tend to hit their highs together simultaneously within a few months of each other. For silver to hit its old high, it's got to triple in price. And if we think gold will probably start off, but when silver starts to play catch up, it'll go up way more than gold, we think. So we think the way to play this, which is reflected in our fund, is you play the mid-tier to slightly large silver mining producers, cash flow producing, not the exploration, not the giant big gold mining companies, but the mid-tier silver producers.
Can you give us some picks that you like?
Sure. Just go through the card. I mean, Fortuna, Mag Silver. I mean, so on and so forth. But Endeavour Silver is a good company. Pan American Silver. I mean, there's not many in that silver space we don't like, and they're all, as I said earlier, all cash flow producing at the moment as well. Got all-in sustaining costs. Depends on company to company, but $10, $11, $12 an ounce. So they're all making money.
Shane?
Thanks. Well, for the time being, I'm more optimistic on gold, just for the short term. I think we all know that, as someone else said, probably the best time to start investing heavily in precious metals, if you're optimistic for the year, is to invest early in the summer, because we get that late summer rally that often goes into September. But I think the fact that physical demand has been quite depressed, and I mean away from central banks, I just mean the coin market in the United States is really, it's been extremely depressed. This year is, we're breaking down in terms of coins that have been sold. I mean, you've probably seen the statistics. I don't know them off the top of my head, but you know they're pretty bad. And physical demand in Asia has been quite subdued. So I guess I'm a broken record, but I do think we need to see gold lead the way for silver to get energized. And I think I would agree with you that it will come fairly quickly. Once gold gains traction, silver will quickly bounce back higher. But for the time being, I'm more optimistic on gold.
And how do you like to be exposed to gold here?
Well, I do like royalty companies. Royal Gold is one of them. I like many of the larger stocks for now, larger cap stocks. Fairly defensive, I must say.
Doug?
Great. Well, we're kind of across the spectrum, but approximately 12%, 13% of our portfolio is in gold bullion, which is vaulted outside the financial system. It's actually vaulted here in the New York area by Brinks. So we want direct exposure to gold for our investors. Another 30+% is exposed to the mid-cap, to the larger cap names. Of that, of the total, 15% would be royalties, Franco, Wheaton Precious Metals, Royal Gold, Osisko Royalties. Approximately 15% of the total is in the silver companies. Pan American Silver is one of our larger positions. And then the remaining, I think maybe now we're down to about 30%, 35%, is in the smaller cap to the mid-cap names that we think really add the value for our investors as those companies get re-rated. We recently added to Detour. Despite their downfall, we think there's tremendous value there, and we anticipate that management will ultimately be forced to reconcile its past, and the market will take care of that for them. So we're across the board. We're not quite as invested in the small exploration companies that we used to be. We have a handful of those names, but liquidity is our concern, and the duration that they can actually live through is a concern of ours as well. So,
Yeah, so we have investments, again, similar to, we don't have physical bullion, but in terms of the gold stocks that we own, the big stocks, and between gold and silver, we're relatively agnostic, despite and notwithstanding the short-term hits that we can take, we are long-term investors, so we think that, again, silver will eventually catch up to gold. Gold will probably move first. So we are agnostic. We look for really good assets when we buy precious metals mining company. So right now, again, we do have big positions in the royalty companies like Royal Gold, Osisko, Franco-Nevada. In terms of the mining companies, we like Randgold Resources. It's going to generate a lot of free cash flow this year. We think at the end of the year it could pay a $4 to $5 per share dividend. The stock's around $80 a share now, so we think the market will react really well to that. And then in the development stages, we think that there's an opportunity to buy companies now where you've had bigger companies take stakes in these smaller companies at actual premiums to where their stocks are currently trading. Right. So we own Continental Gold, where Newmont bought 20% of the company for $4 a share, and it's trading at $3.50. We think that it's worth around $8 a share once the mine's built. We own Gold Road Resources, where it's an open pit project in Western Australia, where Gold Fields bought 50% of the project at, say, like $1.10 per share valuation. It's trading at 80 cents. So there's a time arbitrage to play in some of these smaller development stage companies where bigger guys have taken stakes.
Vince?
I'd like to address first silver. The past is no predictor of the future, and while I'm not agreeing with you per se, as a silver person, there are three silvers. There's silver below $16, silver, for me, between $16 and $22, and then silver above $22, $23. So if you want to speculate on the metal itself, now's the time to buy it, ignoring even the gold-silver ratio, ignoring the fact that it's not truly money. What killed silver was technology, electronic film. What will rescue silver is industrial applications of technology. Now that we can spread silver thinner, they can use it for windshield de-icing. Technology will rescue the use of silver, much as it has, as it will in batteries. So I don't know that silver will follow gold in the next macro rally, but I do know silver will outperform gold. I mean, there's just no doubt about that. As to gold, physical gold, I don't believe that anyone invests in gold. I believe if you use the term, and it may be semantics among this panel, if you invest in gold, you're lying to yourself. Gold is not, an investment is of something that you buy expecting growth, expecting added value. Gold is insurance. If you buy gold, it is an insurance on equities. Yes, gold tanks when stocks tank. That's because people are cashing in their insurance to cover their margin calls. But gold is insurance on your house. It's supposed to be boring. You don't want to have to think about it. It's not going to do anything for you except hedge your dollar risk. And if you own U.S. companies that get paid and earn dollars and pay dollar dividends, those companies will do well, but on an inflation-adjusted basis, they'll do poorly. Gold helps offset that. Gold's insurance. I don't invest in gold bullion. It's a hedge. If you own money, you should own gold as a hedge. In terms of investing in companies, I don't have specifics to get into here, but my focus is on companies that opt more for operating leverage, or they're in the operating leverage part of their curve, as opposed to the financial leverage. Operating leverage, they're more flexible, they can ramp up their production quicker, they can throw off excess cash and either pay dividends or use them for acquisitions. Financial leverage scares me because of the way the markets, the way central bankers and interest rates can play havoc with undiscovered or financially debt-laden projects. Mm-hmm. So, I like companies that are established and are in a position to buy the fire sale companies that need a catalyst to go up.
Let me just, throw this out here. Besides oil, gold and silver, are there other commodities that seem attractive to you right now? We're also speaking ahead of, Trump's talk on Iran at 2 p.m. So
not oil.
No, I'm a precious metal specialist, so gold and silver are the ones that I would really that I think are going to work out long term. But I do think
More
that,
than the PGMs?
well, I mean, I think the PGMs, right? So yeah, definitely more than the PGMs. I mean, the PGMs again, there's a big technological issue that's happening with the PGMs relative to electrification of vehicles, and right.
Where will they be in 10 years
Yeah,
from now?
exactly.
Yeah.
The PGMs are used for auto catalysts and for diesel primarily. So that I would stay away from PGMs for sure. I mean, copper I think is okay. I mean, I think we're going to be in an environment where what's going to happen, and this kind of speaks to the question of what's going to cause gold to break through and really go to, say, 2000 or its past high. And I think that's going to be a view that the world's central banks and the world's governments are not going to allow another financial crisis to happen, are not going to even allow a recession to happen. And so, or they're going to really, really try to stop it. And the way that they're going to try to stop doing that is by eventually printing lots of money now in Japan and Europe, and eventually it'll happen again in the U.S. And when that happens, the price of all hard assets will go up, and the copper should do fine too.
I'm happy you brought up the central bank. Because before I open this up to the audience, does anyone have any strong feelings about or where the Fed will move next, Vince?
Yeah, sorry guys. When you speak geopolitics, you can't ignore coordinated central bank operations. And I think the academics and economists that run the central banks, they project an aura of hard science. But the reality of central banking economists is they're going to make mistakes. It's an art or a soft science. And for example, we were going to cure deflation in 2009. Well, it took them 10 years to chase deflation down. Did I say inflation? Deflation down. Does anybody really think they're going to get ahead of the inflationary curve? As an analogy, an economist at Lehman back, like 25 years ago when I worked there, would pull a rock out of his pocket. Actually, carry one with me just for this, and he would say to me, "See that? Well, the rock's in here." He'd say, "See this rock?" And I'd say, "Yeah." He goes, "Well, I'm an economist, and this rock is me lowering interest rates. I've lowered interest rates, and this rock keeps away, white tigers. Do you see any white tigers in the room? Well, then the rock must be working." And so the reality is that they'll lower interest rates until they're right naturally through the cycle. And if they're wrong, the taxpayer bears the burden. So I believe inflation is coming as a factor of central banks because there is no correlation when you really look at the statistics between real rates, nominal rates, and gold. It has to do with the reason rates are being raised. If you believe that the Fed is ahead of the curve in raising rates to control inflation, then gold goes down. If you believe the Fed is playing catch up and not being truly frank and honest about the inflationary situation, everyone's working, really not that worried about inflation, then you buy gold in a rising inflation rate environment. So, I don't see any white tigers here.
Yeah,
So the Fed
I wish I had a
job.
photo of a white tiger for you now, Vince. But sure.
This is a very complex subject. I mean, I put an article out on LinkedIn if anyone wants to read it. It's quite complex, entitled "Why Quantitative Easing Has Not Produced Inflation Yet." And it's all to do with, as much as the Fed increased narrow money supply, as fast as they were increasing narrow money supply, velocity of circulation was collapsing. And one cancelled the other out. So people look and say, well, they printed all this money, why hasn't it produced inflation? Mm-hmm. And the answer is that velocity of circulation has collapsed. Now, that begs the next question, why has velocity of circulation collapsed? And people put it down to the 2008 financial crisis and the impairing the ability of the banks to lend money. Problem with that is that velocity of circulation peaked in 1999, 2000, 8 years prior to the financial crash when banks were lending money like drunken sailors. So that argument might be half true, but it's not the full story about what caused the collapse in the velocity of circulation. And if you want a correlation that matches it almost perfectly, it's the US labour participation rate. If you overtrack a chart of US labour participation over the velocity of circulation, you get a near perfect match. And if we're starting to see if that is the causation of the fall in velocity, i.e. people not in the labour force, so they're not spending money, which means that the money isn't turning over, we're now starting for the first time, you're starting to see the US labour participation rate start to rise. Now, if that leads to a rise in the velocity of circulation, while all this printed money still remains somewhere in the background, that may be the trigger for the inflation QE to finally produce inflation.
Can I ask a question directly on that?
Okay.
If the Fed has printed a lot of money,
Yeah.
and they have sterilized it by buying bonds, and we're not getting into the normalization process, the unwinding of QE, there's two things that I would like to hear from you. What about the malinvestment cycle, if you want to call it that we have inflation, it's just in the wrong assets? That's one perspective. Another perspective is that bank balance sheets have been so bad that they've refused to lend to shore up, and that has been a big contributor to the decrease in velocity of money, meaning the Austrians are right and wrong at the same time.
You know, I'm not saying that the financial collapse didn't cause velocity of circulation to fall.
Right.
I'm saying that if you look at a chart of M2 velocity, US M2, it peaked in 1999 and fell for 8 years prior to the crash. So the crash can't adequately explain the full fall in the velocity of circulation.
Understood.
I think we're going to open it up to the floor now if anyone has questions.
Any questions from the floor?
I actually have two questions. The first one is kind of a chicken or an egg question. What has to come first, the M&As or the breakout in the gold price? And the second question is, what's your take on a country such as Canada is completely divested out of their gold bullion?
I'll take the second one first. I thought it was very interesting that Canada fully divested, and it reminded me of another major central bank that sold all its gold, and that was in the late 90s. It was the Bank of England. So if that tells you about something about timing of gold, I hope it does, because perhaps that's an optimistic way of saying perhaps we're due for the next leg up in gold. I'll let you guys answer the first question.
I mean, in terms of M&A, the M&A question, I think you're going to have to see the gold price go, frankly, before, I could kind of waffle here, but I think you're going to have to see the gold price go before you really see M&A pick up. I mean, the big mining companies, the ones that have been best rewarded, like Newmont, have been rewarded because they've been very disciplined with their capital. And they've been able to show that they've been able to grow production through internally generated projects. And so if they go out and do a really big deal, I think that they worry that their multiple will be hit and that their valuation will suffer. So I think that it's going to have to take the gold price to go up, and then they're all going to start to get really scared and say, what's going to go on? Okay, and the market's going to start to say, hey guys, well, what about 2020? What about 2028? What about 2030? You don't have any. I don't see any production there, or I see production declining, and then they're going to go out and buy things.
I guess to that comment, I would say that actually you are seeing M&A. I mean, Lundin is stepping in. You had Hecla step in. Elio steps in to make an acquisition. So you are seeing M&A out there. It's just maybe not at the higher level. And I would voice what Chris is saying too. You probably need a much richer gold price where the cash flow is looking for something to do that's excessive maybe to the strategy the company might have, and thus you'd have the larger companies deploying that capital and wasting away, I guess, with a bad strategy and making an acquisition. But you are seeing the smaller companies merge, so it is out there.
I think we can take, how many more questions, Andrew? That one.
I would like to know if we find out what the central banks of Russia and China hold in their have holdings, how much in gold, how would it affect the price of gold? In other words, if they have a lot, would that bring the price up higher? If they have less, would it bring it lower? Because we have no real idea. They don't publish it.
Well, just quickly, I mean, Russia. I think they announce monthly how much they buy, and so we know that's a tailwind. The fact that they're consistently buying a certain number of tons per month. I forget the number. China, you're right. We don't know how much they own, and I don't know. I mean, I've always, like. People say, so what would happen if it comes out that China all of a sudden they announce that the central bank has currently owns 8,000 or 10,000 tons of gold, which would be more than the U.S. The U.S. has 8,300 tons or something like that. So would that would be great? I mean, maybe not. In this gold market, it'd probably be bad because people would say, oh shoot, well it didn't drive the price up, all this physical buying, and now they're done. So.
Right.
So it might be bad. I don't know.
I think Juan Carlos from World Gold, did you want to say something on that?
Yeah, thank you.
The World Gold Council.
Thank you for your question. So just to complement the answer, there are reportings of both Russia and China. So China for a while was not consistently reporting, so they wouldn't report, and then after 5 years they would say, we have been buying over this amount of time, this amount of gold for the central bank. Since I think it's like 2016 or so, as part of the internationalization of the renminbi, so making sure that it's part of properly accounting for the IMF and so on and so forth, they start to report monthly their purchases of gold through the IMF. And again, they very consistently do that. I mean, they haven't been buying, or at least through the IMF reporting over the past couple of months, while Russia is a little bit more consistent in terms of their monthly purchases. It's a very, very consistent program. But China has been reporting. Now, when they were not reporting years ago, what analysts used to do is to look at net imports from China as well as production and kind of like figure out what would be the equivalent that would be going to central banks that was not purchased through jewelry and make estimates on that. And there were a lot of reports on that. And from that perspective, I think that some of those expectations were embedded into the price. But as I said, for the past several years, China has been more consistent in reporting. Russia has definitely been reporting very consistently through the IMF. And if you're interested, either the IMF, on the IMF website, or on gold.org, you can find those statistics.
Thank you, Juan Carlos. I think that's all the time we have, Andrew. Need to wrap this now. Gentlemen, this was an excellent discussion, and I thank you. Appreciate your time. And thank you
very
for coming.
much.